Hey, what's up guys? John here. Rents are crashing nationwide. In some of the hottest markets, down 5%, 10%.
Renters across the US are getting some relief. Prices are falling. Median rent prices fell for the third consecutive month, according to Realtor.com.
Some of these markets are getting absolutely devastated, like San Francisco, for example, getting absolutely obliterated. But when you look at what's really going on, you're going to see a completely different real estate market. We're going to walk into a situation which I think is going to be the greatest real estate investing opportunity of our lifetime in 2024 and 2025. And I think we're going to see most real estate investors that are extremely leveraged lose everything over the next 12 to 24 months. We're walking into a variety of problems for a lot of these investors and a variety of opportunities for new investors that are thinking about going out there and picking up some deals. So I'm going to show you exactly what's going on to help position you for what I think is going to be a massive money-making opportunity. Please hit the like button. When you hit the like button, YouTube's going to share this content to educate other people about what's really going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by clicking the link in the description below this video to schedule a free strategy session. Take a look at this. So when you're looking at markets such as Austin, for example, Austin average rent $1,638, down 7.3%. Dallas down 6%. Orlando down 5%. Portland, Oregon 5%. Phoenix 5%. What many people don't realize is a lot of these investors buy these deals for a 5% return. So when you have rents falling by 5%, insurance and taxes continuing to rise, it's a problem, right? It's a very, very big problem, especially considering that many of these investors bought in 2020, 2021, 2022, they've got to refinance in 2024 or 2025 at these much higher interest rates. What does that mean? A lot of these investors won't be able to get the loans. And so what is that going to mean? Foreclosure city. That's what's going to happen. A lot of these landlords are going to be giving the keys back to the bank. So look at this situation as it's unfolding. And this isn't just like cherry-picked information. If you look at just the last day, rents fall 5th straight month, right? 2 days ago, rents falling downward slide, 5 straight months. Rental market tracker, asking rents flattened in September. 3 weeks ago, and then boom, 2 days ago, they're falling. So you start to look at what's happening here. Even in markets like Miami, people think there's no way Miami's falling. Miami rents fall and a city sees first population drop in a decade. Now, I put a video out, this maybe 7 months ago, saying that, the housing shortage, that situation that they were selling in the media, is a complete scam. And in fact, we didn't have a housing shortage. And in fact, what's going to happen is they're going to push forward this massive building boom. They propped up the entire real estate market with basically 0% interest rates, forcing people to buy these homes. And as the labor market changes, the economy sinks. All of these investors that lose their jobs, that don't have equity in their home because the average down payment was 6%, and the cost to sell a home is like 8-9% depending on your market, 6% for realtors, and then closing costs, transfer taxes, escrow fees, another 2%, 3%. So you start to look at this situation. I said in this description, however, there's a very big curveball many people are not anticipating in the real estate market. Most people bought these with 2-3% mortgages, will not want to sell their homes, and what will they do? They'll have to operate their property as an investor or landlord and rent it out to make ends meet if they can keep their cheap mortgages, especially when they get laid off from their jobs and they have no equity in their home and they can't sell. Well, as the utility bills and all these upgrades become, basically new normal. I was saying this March 6th, right? March 6th, and then you look here, March 13th. Your 3% mortgage might turn you into a landlord. March 13th, Yahoo News. Homeowners turn to 3% mortgage rates. Everyone's talking about the accidental landlord. Days after I put that video out. And now, when you're starting to look at this, they're telling you what an accidental landlord is. It's exactly what I said it was, right? So you're looking at this situation, you have to ask yourself, how big of a problem is this? 40% of every mortgage in America was taken out at the height of the market. 40%. And you're seeing what's going on right now in the job market, more layoffs. It's harder to keep a job. Employers are really looking at their expenses more closely. And so when you're paying attention to this, you're asking yourself, okay, well, what is Jamie Dimon? What's the Fed going to do? Are they going to reduce interest rates to try to stimulate the economy again? Or are they really going to turn the heat up on this on this economy? And that's what they're going to do. They're going to put the feet to the fire, everyone's feet to the fire, this economy. Jamie Dimon saying that they believe it's going to be a 7% Fed's fund rate. And so right now it's 5.33%. And mortgage rates, if you have perfect credit, 800 credit score, it's 8%. So at a 5.33 funds rate, that's putting us at a perfect credit score, 9.5%, 10%, right? If you have bad credit right now, so let's say a 620, you're 9%, 9% for a 30-year fixed. And so we think about this, all these investors that bought these properties, they can't refinance, they don't have equity in their homes, right? They can't refinance, they can't get access to money. What are they gonna do? They're gonna start renting out their homes. With 40% of mortgages originated, 2020, 2021, these record low interest rates, they have very low carrying costs as of now. So what are they gonna do? They're gonna go to the market and they're gonna try to rent out these homes at a cost basis that's above what they have. So if they're spending $2,000 a month for this $400,000 house, they can rent it for $2,200. They probably will, right? They probably will rent it out. If a 2-bedroom apartment in a local city is, let's call it $2,200, that's a problem for the owner of that 2-bedroom apartment building, right? They're gonna have to reduce their rents to $1,800 or $1,850 because being in a house is much nicer than being in an apartment in most cases. So what is gonna happen? All this new inventory is gonna continue to hit the market, driving rental prices down, but yet borrowing costs are pushing, being a homeowner to extreme levels. Buying a $450,000 house, 8% mortgage, considering you had perfect credit, 800 credit score, $3,700 plus maintenance costs, and the cost of being a homeowner, probably $4,000 a month. Who's going to opt in for that? Nobody. Nobody is going to opt in for most cases, or arguments cases. No one's going to opt in for a $4,000 a month payment when they could rent for $2,000 and they could hold on to the down payment money and invest it in their business or save it, right? In this uncertain world, what are they going to do? They're going to wait because a lot of people are anticipating a real estate crash. They're anticipating opportunity. And so if they're sitting with cash in the bank and a good credit score, they're likely going to just do that. So you're going to start to see the pool of available buyers continue to shrink. And as that happens, prices are likely going to continue to sink. People don't have equity in their homes. They're going to rent out their homes. It's going to force this huge amount of pressure on a lot of landlords that are extremely leveraged. A lot of pressure. And with that, 461,000 units are expected to be built just this year. It's a 50-year high on apartment construction. With these layoffs happening and then you have foreclosures increasing, September alone, 11% jump. You got to ask yourself, we live in a world of probabilities. What are the odds that rents continue to rise as wages start to soften and you see a bunch of new inventory? The odds are very, very slim, right? The odds are slim. And how much equity do most commercial real estate investors have in their properties? Not much. Many people refinance all their cash out of these deals, and most people, they're holding on to a bunch of really, really bad deals. And so what is this going to mean? It's going to mean a complete restructuring of the real estate market. That's what we're walking into, a massive restructuring of the real estate market. And I was letting people know that I thought rents were really going to crash, and that's what's now starting to happen. But you have to ask yourself, how much can rents go down? If they went down, in Austin, they're saying, rents have fallen 7%. And Austin, for example, the specific market, population of 973,000 people, they have 233,000 rental units. They're building and bringing to market 120,000 units. They're going to increase inventory 53%. And just this location alone, and this is happening in many other areas, they're now allowing residential, single-family, R1 zoning to build ADUs on their property. So if the market's changing, you might see many people opting to try to put an ADU on the lot, try to bring in some extra cash flow. You're going to start seeing just a lot more inventory come to market. Long story short, rents are coming down. That's what I think is going to happen. Pressure is going to be put on landlords, and opportunity is going to be given to those with cash, credit, a game plan, and knowledge. They know what to do. They know how to invest. They know where to go. This is what's going to happen. I think we're going to walk into a big opportunity here. You look at Barry Starwood Capital Group, 180,000 single-family homes. He's raising money for a distressed real estate fund. You look at Blackstone. They just raised a $30 billion, $400 million fund. So $30 billion, $400 million real estate fund investing primarily in single-family rentals. They're not buying right now. They're holding cash, looking for opportunity. They're waiting. You look at what the smart money is doing. They're going to get into rentals as these investors, these landlords really bleed out and the economy completely goes into a different type of softening that we haven't seen before. And we start to see a lot of debt come due. They're going to come forward, back up the dump truck of cash, and buy up as much as they possibly can. So position yourself, follow the smart money. That's what they're doing. And I think they're doing it for a very, very, very clear reason. What do you think about this situation? Do you think we're walking into a scenario over the next 12 months, 24 months, where we're going to start to see a lot of homeowners, a lot of property owners be forced to rent out their homes, be forced to try to find a tenant? And because of that, coupled with a variety of other problems, we're going to start to see rents continuing to soften and presenting an opportunity where it's going to be much more attractive to be a renter in the short term. Well, of course, you have to think about it. When all these big corporations are buying up all these houses, what are they going to do? They're going to continue they're going to continue to increase the rates in which renters pay. Just like with advertising on Facebook, for example. It was very cheap to advertise on Facebook in 2010, 2012. You could get in front of a customer for basically for free. Now it's extremely expensive to get in front of a customer on Facebook, depending on your niche, of course. But their cost basis is very low. Now imagine if these institutional investors are running out there buying up all these properties, and they're buying it based on a very, very low cost basis, and they have market share. What are they going to do? Together they'll control market, and they'll continue to increase rates and be able to absorb the wealth from the middle class and from the 99%. So position yourself to be a 1%er over the next couple of years. Even if you don't feel like you're there yet, you will be with the right game plan, the right strategy. All it takes is one really, really good deal, and it's a complete game changer. So I think a lot of people will go out there and find that great opportunity, that great real estate deal. But you have to put yourself in the right position. Cash, credit, knowledge, and a game plan. What do you think about it? Drop below, hit the like button. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item on your credit report, go to GreatCreditFast.com by clicking the link in the description below this video, and I'll catch you in the next one.